Hey traders, welcome back. So today, while we're talking about position sizing, let's talk about the fixed fractional position sizing. And what is that all about? What does it mean? What's the point in it? What's the advantages? What's the disadvantages? How can we use it to make more money in our trading? Let's talk about it. So the standard one is basically 2%. Now, what does that 2% mean? Does it mean anything? What's it all about? What you're doing with fixed fractional position sizing is saying, listen, I'm only going to risk a percentage of my trading account on each trade. So if you're trading with a £10,000 account, you're only going to risk 2% of that, which is £200 per trade. Okay, so each trade you take, you cannot risk more than 2%. Now, then you have to work out your position sizing from that. And you need to say, okay, £200 is my risk. I've got a 20 tick stop loss on this if we're day trading, for example, so I can afford to do £10 a point, and vice versa. Obviously, if there's a larger stop, you're going to reduce your position size. If there's a smaller stop, you can increase your position size. This is a fixed position size risk. It's almost like saying, hey, this is my capital. I'm going to allocate that amount of funds to this trade idea, and each time I allocate the same amount of funds, how that's distributed within that trade is irrelevant, whether it's a small amount or a large position size, or whether it's a big amount and very small stop, then it doesn't really matter, as long as the risk is the same. Okay, now, obviously the advantage of this is that as your account grows, or as your account, let's use the analogy of it growing first. As your account grows, you're increasing your position size with the growth of the account. So you're getting the same kind of results as you would be if you're on 10 grand. If you go up to 100 grand and you've moved it up nicely, you're still risking 2%. So at this time, you're risking £2,000 on each trade. Similarly, if we look at the flip side of that, and we start to lose money, what we end up doing is we end up reducing our position size because we don't want to increase the chance of us going bust. Now, the thing is with this, that's one of the positives of this situation, is that if you were to keep yourself fixed at £200, and let's say you halved your trading account to 5,000, all of a sudden your risk has gone up to 4% of the account. And let's say you halved it again, all of a sudden your risk is getting a much more. So the risk of ruin becomes significant, because as you're losing more and more money, you're effectively taking on more and more risk. So you really have a danger that when you start to go down and down and down because you're not performing, whatever the situation may be, it happens to everybody at some point. If you're risking the same amount, you're just doing more and more damage. And let's take the maths out of it for a second and just look at it from a trading psychology perspective and a trading performance perspective, and just from experience of trading. You know, I know, and you probably know as well, that when you're in a slump, you're in a slump, whatever that may be. It may be because you're out of tune with the market. Whatever happening is just not working for you. It could be that your system's fine, but you're just going through a period of loss. You know, this is natural in trading. This is how it's going to be. Now, what you don't want to do with that is have that do more damage to you than it should do. It's going to come, it happens, you're going to get hit with it from time to time. How you deal with it as a trader is also crucial to your long-term performance. And doing something like this, where you're constantly dialing down the risk as you're reducing and dialing the risk back up as you're increasing, makes a lot of sense. Now, of course, the problem you have is that if you're dialing down the risk, it's going to take you more trades to get back up to where you were, if that makes sense. So let's say you had 10 losing trades in a row, and obviously you're going to do 200, then you're going to take 200 off that, so then you're going to take 2% of that subsequent balance and then keep going down. So you're going to have to adjust your position size to suit as you go, which is also a little bit of a pain if you're trading and you're doing 2% for every single trade. You've got to recalculate and redo your position size, and quite often you're not going to accurately get 200 exactly, because you may want to be doing some sort of shares position size, or you may want to do a pair trade or something, and that's very difficult. So you might only be able to get that within 10%. But anyway, the point I was making is that as you reduce your capital size, you're going to need more than the trades you lost. Let's say you lost 10 trades, you're going to need more than 10 winning trades, obviously assuming that the value of the winner is the same as the loser. In the real world, you want it better than that, but let's just use that hypothetically for now, to get back to where you were. It's like the old adage of, you know, if you lose 50% of your account, you've got to make 100% to get back to where you were before. And if you're using this adjusted position size ratio, this fractional position sizing, it's going to amplify that. You're going to have to make a lot more trades to get back to where you were. So You know, that is the downside of it. Of course, it's protecting you, but it's like anything in trading and pretty much in life, isn't it, guys? You know, as the more risk you take, the more potential reward you have. The less risk you take, the less potential reward. And you've got to kind of find that balance that's right for you and say, hey, you know what? I just want to dial the risk right down. You know, I'm not interested in making huge gains. I just want to get rid of, dial as much risk out as possible. And then you have your scale kind of twisted like that. Or the other end of the scale, you're like, listen, I don't care about risk. I'm just going flat out as much as I can. And I want to make as much money as possible. The risk is massive, but the reward again is massive. So it's finding that medium. I mean, none of us want to be at either end of that scale. We all want to make as much money as we can for as little risk as we can. So we don't want to blow up. But at the same time, we want to make it worth our while, right? We're here to make money. We're here to profit from the market somehow. So, you know, there's no point in doing it and having, you know, just a small gain for all that effort. So we've got to find that happy medium. I mean, one thing you could do is you could kind of use this as a base, as a foundation. Say, listen, I'm going to use 2%, but then maybe you ratchet it down to a smaller position size within a range. So let's say, you know, 10% either side of that, so 9 to 11,000, you stick at your 200. And then as you move up or down from that, you can adjust it to suit. Now, mathematically that works, but again, let's just move very quickly before we end the video, guys, is that think about it from a psychological perspective. You know, if you're reducing your position size down, yes, you're protecting your risk, but the impact of then saying, listen, you know, I've got to get so much more to get back in the game may well not do you any favors. And also, let's consider, and actually from a strategy perspective very quickly, is that let's say you, for whatever reason, forget about the reasons for this, let's say you're looking to buy something that's pushing down. Okay, it's pushing down, looking to buy. You know, you get stopped out. You get stopped out several times. In fact, maybe that's over the course of a few months. Then, you know, eventually you get it right. But by this time, you're in, you reduce your position size. It's going to take you longer to get back up to where you were. If you get on the end of it, you're going to be in a lower position size. So that's obviously a small downside. But obviously, the good upside of that is that if you continue to be wrong, it's not going to hammer you completely. You're not going to keep having that 200 and you've only got £1,000 left in your account, for example. You've got to reduce the size to suit. So this is great for learning. This is great for starting out in trading and you just want to get experience in the market. You're not interested in really pushing the throttle and making a lot of money. You're not interested in anything else but getting the experience, sorting out your strategies, but just not blowing up. You want to be in here 3 years from now. You're starting today, for example. You want to be in the game 3 years from now, experienced with strategies, ready to put some real money on the line, some real risk on the line, and try and make some money out of this game. So that will keep you in the game as long as possible. As you inevitably lose money when you first start trading, it means that your risk is reduced, so you're never ever going to get to a point where you're wiped out unless you ignore this and go crazy. I mean, it is possible, obviously, but because your size is getting smaller and smaller and smaller and smaller and smaller, obviously it'll get to a point where you're down to £1 a point or something and you can't go any lower than that. But you know, you will have it'll make your account, you know, last much longer if you consider that, hey, that's your kind of schooling tuition fee, if you like. Maybe 10,000 is a bit much, but that's your tuition fee and you want to stay in the game as long as possible while playing that. And this is not a bad way of doing it. You know, and then you can reapproach it and reevaluate after that time period is gone and said, how did I do? You know, what worked for me, what didn't work for me, etc. So anyway, that's fixed fractional position sizing. I'm going to talk about some more ways for risk management and position sizing in future videos and also some previous videos. Go and check them out on the channel. If you like this, give it a thumbs up. If you want to subscribe, please do so for more videos from me and other traders on here. And as always, I welcome your comments below. Let me know what you think about this. Do you think it's any good? Yes, no, do you use it? How do you structure your trades? Always read them. Love to hear what you guys have got to say. Anyway, see you in the next video, guys. Take care. Bye-bye.